Hello everyone and thank you for watching Edupedia World videos. Today we are going to continue with our Unit 4 of Chapter 1, that is Concepts of Previous Year and Assessment Year. So let us start our class with Unit 4. We already know the learning objectives for this unit, and today we are going to continue with the second learning objective of this unit. We are done with the first learning objective and we have started the second learning objective in the previous class, and now we are going to continue with the second learning objective and complete it in today's session. What we are going to do is the previous year for undisclosed sources of income. We are going to discuss further the undisclosed sources of income. So let us start our class. In the previous class, we have done till unexplained money in the undisclosed sources of income. We were doing the undisclosed sources of income and we have done cash credits, unexplained investment and unexplained money. In today's class, we'll continue with that topic and we'll move on to the fourth undisclosed source of income, and that is amount of investments etc. not fully disclosed in the books of accounts. It is covered under section 69B of the Income Tax Act. Up till now, we were discussing the undisclosed sources of income which are totally undisclosed in the books of accounts. But in this section, it is given that amount of investment, money, etc. not fully disclosed in the books of accounts. So, what does that mean is that we are disclosing some amount of the investments and some amount of the money we are possessing in our accounts, but we are not fully disclosing it. That is, the value which we are disclosing does not represent the real value, the total value of investments and money. So let us read the point. Wherein any financial year the assessee has made investments or is found to be the owner of any bullion, jewelry or other valuable article, and the assessing officer finds that the amount spent on making such investments or in acquiring such articles exceeds the amount recorded in the books of account maintained by the assessee. So here what is given is that only that we are spending money on some bullion jewelry, in buying some bullions or jewelries or other valuable articles, or we are making some investments and we are recording that in our books of accounts. But the amount recorded in the books of account maintained by the assessee is not the real amount, meaning we are not fully disclosing the amount we are investing or the amount we are spending in owning any bullion or jewelry. And the assessing officers came to know about it, and when inquired, we are not able to offer any explanation to the assessing officer, or the explanation offered by us is unsatisfactory, then such excess may be deemed to be the income of the assessee for such financial year. Now we'll take one example to make this point more clear. For example, if the assessee is found to be the owner of say 300 grams of gold, the market value of which is rupees 25,000 during the financial year ending 31st March 2015, but he has recorded to have spent 15,000 only in acquiring it. He is acquiring gold of value 25,000, but in his books of accounts he is recording only 15,000. So the assessing officer can add 10,000, that is the difference of the market value of such gold, and 15,000 as the income of the assessee if the assessee offers no satisfactory explanation thereof. So the assessing officer has the power and has the authority to not only add the difference of the market value but also the value which has been recorded. So if I am buying gold and I am not recording it on the market value, rather than I am recording it at a value which is lower than the market value, then the assessing officer has the power to add the difference of the market value and the value which is recorded in the books of account if I am not able to offer any satisfactory explanation to the assessing officer. So this is section 69B covering the amount of investment etc. not fully disclosed in the books of account. The word which is important and which is relevant in this section is not fully disclosed. Okay. Next comes unexplained expenditure under section 69C. What is unexplained expenditure? Where in any financial year an assessee has incurred any expenditure and he offers no explanation about the source of such expenditure, or the explanation is unsatisfactory, the assessing officer can treat such unexplained expenditure as the income of the assessee for such financial year. Such unexplained expenditure which is deemed to be the income of the assessee shall not be allowed as deduction under any head of income. So, let us take one example and understand this point more clearly. Suppose I am spending 50 lakhs rupees on my daughter's wedding, and the assessing officer comes to know about this fact that I have spent 50 lakhs rupees on my daughter's wedding, and on inquiring I am not able to explain the source of income from which I am able to expend such huge amount of money on my daughter's wedding. I am unable to satisfy the assessing officer about the source of income from where I got such huge money and have spended this big amount on my daughter's wedding. So if I am not able to satisfy the assessing officer and I am not able to give any satisfactory explanation to him, then that 50 lakh rupees which I have spent on my daughter's wedding will be treated as my income for that year. And further, such expenditure which I have spent on my daughter's wedding will not be allowed as deduction under any head of income. That expenditure will not be deducted from any head of income. That will be chargeable to tax as my income for that year. So this is what is unexplained expenditure. If I am not able to explain the source of income about any expenditure which I am expending, then that will be treated as my income for that year and that will be taxed accordingly. Next comes section 69D. This is the last point under this topic of undisclosed sources of income, and that is amount borrowed or repaid on hundi. What is a hundi? First of all, we need to know this. According to the definition issued by the RBI, hundis refer to financial instruments evolved on the Indian subcontinent used in trade and credit transactions. It is a financial instrument which has evolved in Indian subcontinent only and which was used for trade and credit transactions. They were used for remittance, that is to transfer funds from one place to another, and credit instrument, that is the main use of this hundi. It was used as a credit instrument, that is to borrow money. So hundis are, in a sense you can say, a bill of exchange which is used as a credit instrument to borrow money. So it is given in our IT Act that where any amount is borrowed on a hundi, if I am borrowing any amount on a hundi does not hold any legal status. It is just, you can say, an illegal method of borrowing money because it is not covered by the Negotiable Instrument Act 1888. So it does not hold any legal status. So according to our IT Act, if any amount is borrowed on a hundi or any amount due thereon, that is any amount which I have to pay back, which I have borrowed on a hundi, is repaid, I am repaying the amount borrowed other than through an account pay check drawn on a bank. I am paying back the money borrowed on a hundi by anything other than the account pay check drawn on a bank. Then such amount borrowed or repaid shall be deemed to be the income of the person borrowing or repaying for the previous year in which the amount was borrowed or repaid, as the case may be. So, what this point is all about is that I cannot borrow money on a hundi. So, if I am borrowing money on a hundi, then the money which I am borrowing will be assessed as my income for that previous year in which I borrowed. Or if that borrowed amount is not taxed, then the repaid amount will be taxed. If I am repaying the amount borrowed on a hundi other than the account paycheck drawn on a bank, the mode of repaying is not an account paycheck, then the amount repaid will be taxed as my income in that previous year. So, this is all about amount borrowed or repaid on a hundi, section 69D. But one thing more is there, that is, where any amount borrowed on a hundi has been deemed to be the income of any person, then he will not be again liable to be assessed in respect of such amount on repayment of such amount. Meaning, either I can be taxed while I am borrowing or I am repaying. I cannot be taxed both the times. If I am being taxed at the time of borrowing money on hundi, then again I will not be taxed when I'll be repaying that amount. So I can be taxed only once, either at the time of borrowing or at the time of repaying. And the amount repaid shall include interest paid on the amount borrowed. If I am being taxed on the amount repaid, then that amount repaid will include the interest paid on the amount borrowed. So this is all about section 69D, amount borrowed or repaid on hundi. This was our last topic. We are done with the undisclosed sources of income. We started with cash credits, then unexplained investment, unexplained money, unexplained investment money, etc., not fully disclosed, and then we did the unexplained expenditure, and now the last thing, amount borrowed or repaid on hundi. So these are the 6 undisclosed sources of income which, if we do not disclose, then these amounts will form part of our income and will be taxed accordingly. We have done the various undisclosed sources of income, and now in this slide we'll get to know the rate of tax at which these unexplained sources of income will be taxed. It is covered under section 115 BBE. What does this section says? In order to control laundering of unaccounted money by availing the benefit of basic exemption limit, the unexplained money, investment, expenditure, etc., deemed as income under section 68 or section 69 or section 69A, 69B, 69C or section 69D, all these undisclosed sources of income will be taxed at the flat rate of 30%. Since these income are undisclosed, they are being penalized at a higher rate of tax because the government needs to control the laundering of the flow of unaccounted money. These are the unaccounted money, and the government needs to control the flow of these unaccounted money in the economy in order to control the circulation of black money. That is the reason these undisclosed sources of income are being taxed at a very high rate of 30%. Once again, we'll revise what are the undisclosed sources of income. Section 68, cash credits. Section 69, unexplained investment. Section 69A, unexplained money, investment, etc. Section 69B, investment money not fully disclosed. Section 69C, unexplained expenditure, and section 69D, amount borrowed or repaid on hundi. All these are the undisclosed sources of income which are taxed at the flat rate of 30%. One more thing about these undisclosed sources of income is that No basic exemption or allowance or expenditure shall be allowed to the SSE under any provision of the Income Tax Act in computing such deemed income. Meaning, I'll not be allowed any exemption or allowance if I am being taxed under these sections. If I am not disclosing my cash credits, not disclosing my investment, money, etc., then I will not be allowed any expenditure or exemption which I have made regarding these investments or these cash credits. No expenditure or allowance will be allowed to me, and the whole amount will be taxed at the rate of 30%. Thank you, students. Hope you have found this class worthy. And in the next class, we'll finish this unit by covering the last learning objective of Unit 4. Thank you.